Hey guys, it's Chris Mincola with the Mincola Group over at West USA Realty. Just wanted to do our weekly market update on the housing market here in the Phoenix area and a little bit of countrywide info for you. Right off the bat, I'm going to say this. I want to give everybody a few tips. First of all, I get this question a lot. Is there a way to get lower rates right now or whatever? I would say this, and I'm going to show you what the numbers are right now from what I'm talking about. When you see those high interest rates out there that people talk about, okay, those are the average rates that are offered, taken from retail lenders and stuff. We deal with, call it wholesale, call it whatever you want, but mortgage broker. When you have a broker, uh, they shop the best rates. They're usually going to give you a better deal as far as what they're charging. So right off the bat, you're getting that huge value with a great lender that is actually going to close much faster than a lot of the other lenders out there to close on time. I've seen just the run of the mill, type of loans and stuff, closing ready to go within 2 to 3 weeks, as long as you're getting your inspections and appraisals done. Let's say 3 weeks, okay, to be on the safe side, because appraisals can take a little bit longer sometimes. But the our people really and it's so important because you're thinking about moving and stuff. It's really important. So that's a great thing, and then they're automatically going to, I've just seen automatically lower rates than what is normal out there for all the other big companies. Okay. And that's one of the reasons why they're able to shop lower rates, offer lower fees, and all that, because they don't have the big brick and mortar stuff that you're normally dealing with. Okay. So there's that just right off the bat. Then there are ways you can get, a lot of people think about the price of a property. More importantly, especially right now, you may want to think, not that you wouldn't mind, maybe getting a lower price on anything, but more importantly, because if you ask for what are called concessions, which is maybe, some help with closing costs, which your lender and title fees, things like that. Also your if you would like a lower rate beyond what I just talked about, you can get there's 2 1 3 2 1 2 1 buy down programs. There's a lot of different loan programs out there. Basically, what that means is maybe your first 2 or 3 years, your rates are a little bit lower than they would be. Hopefully by then rates go down, you can refinance out of it. Or just buying straight buy down rates, straight, just buying down a fixed rate to get you better pricing on your payments. Okay. These are things that I would advise my clients who are looking to buy a home to think about more. And you're not in the business, so a lot of times people aren't necessarily thinking that deep into things. But from our end, this will give you a much lower payment, and in the end, it'll save you. Rather than just getting maybe $10,000 off a property, it could save you tens of thousands of dollars over the life of a loan. Not that you're going to necessarily be there 30 years, but I think you get the drift. Over a set number of years, no loan officer could show you this and build it out. You'd be saving, more than just getting 5 or 10 grand off the price of a property. So more importantly, right now, I would be looking at those type of conversations to have with your realtor or with us, with your lender. I know pricing's gone up a little bit over the last week or two, but just in the last 2 or 3 weeks, a few times I've seen FHA running in the mid fives. And conventional is usually going to be a little bit higher than that. But you're seeing on TV or on the news and the doom and gloom retail average rates. You're seeing you typically somewhere between 7.25 up to 7.5 in the last week or two. And what's caused that? Well, great question. We'll get into that in just a second. Another way to get lower rates right now is buy a new home. In most cases, here in the Valley, here in Phoenix area, in the metro area, you're going to be getting a buy down through the concessions they're offering. Okay. Also, taking care of closing costs in many cases. Okay. So they're very competitive. The new home market is very competitive. I would definitely recommend we take a look at that as a strategy to help get you the best value, and it's brand new. Obviously, there's things with a resale home that may be better. Maybe the home already has a pool if you want one, or a spa. Maybe the property's already landscaped, things like that. That maybe with a new home you're not going to necessarily have. You're going to have to do those things. Um, there's also something else out there, and this doesn't work for everybody. Again, these are just some options, some ideas. Okay. But some things that we can, talk over on strategy with us and the lender. But um, looking at assuming somebody else's loan. So somebody else has an FHA or BA type of property, or Fannie Mae, Freddie Mac type of loan product on their current property. There's a way to assume their loan, okay, as long as their lender is okay with it. There's a way to assume that loan, okay, and take over payments of that loan, so that you can get maybe the lower rate they have. So if they have a 2%, 3%, 4% rate, you can assume that. And then, again, if as long as everybody agrees on both sides, this is something that is an actual thing. Now, it doesn't always get approved. It can take up to 90 days and in most cases to get approval and all that. But that is something that we can look at. And one of the other things too that we're dealing with in a low inventory situation and in this type of environment where maybe some sellers are not moving right away, is that we can look at those type of things for people who are selling and buying. And if you're not finding what you like, and we know a specific neighborhood community that you're looking to be in, obviously you can't say the city of Glendale, all right, but we can actually reach out to homeowners that fit your criteria, and maybe they're having a loan that would make sense to assume. Again, you would have to, we'd have to talk about the details and how much money you'd have to be carrying over to assume that loan and all that sorts of things. But we can certainly talk about the details of that with the lender. But anyway, those are just some ideas to look at getting into a home, making a move if you need to. Again, people ask me, should I buy now? Should I not? When's the right time to buy? Timing the market is not really a thing that I would suggest in doing. What I would suggest more of is if you need to move, or you really want to buy a house, or you really want to, move on with your life, get the lifestyle you want, be in the area you want, near work, or move for work, all those sorts of things. Can you afford to move? Can you afford to buy? Whether you're selling and buying, or just first time home buyer, or you're buying a home maybe but don't own a property already. Can you afford to buy a home right now? Can you get qualified? Can you afford the payment and all those sorts of things? Um, it's still better to buy than rent if you are going to be in a property for minimum 3 to 4, 5 years. Okay. Even into the third year, full third year, we can break it down where you're going to come out ahead by, just with taking the average home prices right now across the country. You'd probably be coming out around $15,000 ahead when you take the compound interest. Plus, your rent's not going to go up, right? Your rent, if you're in a fixed rate, your rent's not going to go up, right? Your payment's not going to go up. Your mortgage isn't going to go up like it does with rent. Um, Plus, you're going to actually own something, so it's yours. So that's always a better lifestyle. Also, home prices over the past, go back 75 years, except for like 4 bad years, or 4 or 5 bad years that we had during a crash, which was a totally different situation with a lot of variables there that we're just don't have right now at all. And then one maybe even year, if you want to call it that, out of 75 years, that's not bad. Okay. And it's different than investing in gold. Okay. It's different than investing in gold or silver, things like that, or, whatever else, because you have to make that payment anyway, right? You got to pay rent or pay a mortgage anyway. You got to live somewhere unless you're living in a tent. Okay. You've got to make that payment anyway. So, it's one of the greatest ways to build wealth. We've talked about this many times, but a homeowner is 40 times more, has 40 times more wealth than a renter. And anyways, I can go on and on about that. Another question we get a lot is, what about down payment assistance, Chris? I've heard about all these programs. Well, there are a million down payment assistance programs out there, whether they're local to the county that you're in, maybe even city, maybe to the lender themselves, to the state. There's some nationwide type of programs. There's all kinds of different programs out there. Here's the thing you got to understand. With a down payment assistance program, they are all going to have um, a higher payment, right? They're all going to have a higher payment. You're getting that money up front for your down payment, but it's going to cost you more on a mortgage. Now, right now, and I'm going to talk about this too more in a second. We're in a balanced market right now. So for buyers, not only asking for concessions, in other words, money from the seller, it comes off their net, of course, but we can negotiate in where you could, get those rate buy downs and things and to pay for those other closing cost fees. But also, it may make sense to do down payment assistance right now and get a good price on a property. Okay. In other words, we negotiate a good price, even though you're paying maybe a little bit more in fees for the program, for the down payment assistance program and for the rate. And then later on, when rates drop, you can look at refinancing when that makes sense. So, when you're looking at a $500,000 house, let's just say, um, 1%, there are 1% programs. There are total grants where you don't have to pay anything back. There's second mortgages that kind of sit there with your regular 30-year mortgage for the down payment. There's all kinds of different programs out there, but it's it's important to kind of to understand it up front about the payment, the fees, and all that. Also, it may take maybe 5 to 10 days more to close just to get through their processing and stuff on those type of programs. And then but at least you own a home. You're gaining equity. You're not throwing money out the window, right? So because rent is a 100% interest rate because your money's just going to nothing. Okay. Some people feel it's more flexible. I can understand maybe if you're moving to a new area you have no idea about and that sort of thing. Or if you're only going to be in a place for a year or two. Yeah, I totally get that. But other than that, that's that. So there's a little bit on those two things. I get tons of questions on that all the time. But now might be a good time to look at down payment assistance because we can negotiate or for getting lower rates because we can negotiate a lot of this stuff in right now since we're in more of a balanced market here in the Phoenix area. And it kind of, again, every area is a little different, but because the rates have really stagnated things and really dropped and collapsed demand, the higher demand that we've had. The only reason why prices are going up is because inventory is still super low. But because the rates have kind of stagnated things, we were in kind of that balanced market. So people say, is it a good time to buy? I say, yeah, actually it is because we can negotiate more things. And now in a way, it sounds crazy, in a perfect world, where, inventory was limitless or whatever, it wouldn't be such a thing. But when those rates do drop eventually, we better hope that there's a little bit more inventory as a buffer because we're going to see a buying frenzy because of all the pent up demand. Because for about every 1% drop, we see that 5 million more people across the country can now jump into the market, can now afford to jump into the market. And that number may even be a little bit higher now because of the higher population that we're seeing past Generation X come into the mix, which I've talked about before in the past several occasions. So This week for pricing, we had war. We had a lot of war things happening over in Middle East and stuff. We had Iran and Israel, the whole thing. So one of the things to watch is oil, wheat prices, all those sorts of things, inflation. 10-year yield shot up when this happened, and GDP is well below estimates, taking out the consumption variable. It was very strong in the GDP. So the GDP prices paid in the GDP number, okay, which isn't that surprising the last few months on PCE data. But for those that saw the headline and thought that means we might see some better numbers, that's why, because of the consumption variable that was very strong into GDP. So even though overall GDP was below estimates, sorry, my allergies are just crazy right now. So even though we have made progress in year over year inflation, we see the quarterly inflation data wasn't good. It wasn't as good as we hoped. And I mean, when you're servicing, one thing besides looking at oil and wheat and war and all those sorts of things, when we're servicing $1 trillion in debt every 100 days, doesn't help. And when we keep printing more money for all these extra things that I've talked about a million times, that's all inflationary. So, but keep in mind that the Fed, as far as the Fed's concerned, whether we agree with them or not, they're looking at the PCE, okay, personal consumption, and that as far as inflation goes. Um, so that year over year inflation data wasn't good as we hoped. So only recently the Fed admitted that what they're really tracking is jobless claims. So with that, we have been looking for a 4-week moving average to hit 323,000, and we don't go into a recession until we actually break that. Okay, or even head towards that area, we're still going to we're still at the lower level, and the labor market is softening but not breaking. Okay, there's a difference between softening and breaking. So, what we can get into, whether it's part-time work or full-time work, middle class incomes, all that, but we're waiting for some of that seasonal adjustment stuff to catch up on some of this data. It's taken longer than we had hoped. Again, a lot of this stuff, moving goalposts, all that. So hopefully we'll see that sooner rather than later. We have a little bit higher inventory year over year by a little. So, more options for home buyers, which if we had 6% rates or lower, we would see, more properties under contract faster. Home sales dropped in March. Home sales, the number of home sales, not prices, but number of home sales, but due to higher rates. Okay. And mortgage applications just dropped. However, due to low inventory, it's still not enough, for uh, enough demand for prices to gone over, or go down. So we're still in that low inventory, enough demand and that sort of thing to keep prices going up. So, but we've gone over 7% over, in the last 12 months. We were at about, let's see, we went from in the last 12 months, 279 per square foot. When we saw prices drop in 2022, right around December of 2022 was the low point. After rates shot up around April, May of 2022. And we were just over 300 per square foot on average. Our high was about 305, a little over 305 per square foot. And the height all the way to 2022 around spring. So if prices rise another 2%, we'll pass the all-time highs. All right. So the sales volume is down, but prices actually in a luxury market are doing great. Sales are doing good comparably. Of course, insurance is up, which affects payments a little bit. Insurance is up, was it 20 or 30% now? so we could certainly use more inventory for a buffer built in. So again, when rates fall, we don't see this skyrocketing. Keep in mind, a lot of people want to talk about the crash. Keep in mind, 2008 to 2012 for inventory was different also because the sales numbers that were not buyers in that they could not buy due to foreclosure or short sale. Okay. So they're losing their homes, but they weren't going on to buy something. So it's a little bit different inventory situation too back then. We have a little bit more listings, people are selling and then buying um, now compared to then because of those factors. They're just moving slower. If rates would have continued to drop and they, did at the end of the year, beginning of this year, um, everybody was hoping that was going to continue. But, right now, we're probably looking at 1 to 2 cuts, and not around June or July, but maybe closer to September. Um, we may see a cut and then another one before the end of the year, hopefully, but we'll have to wait and see. At this point, it's, between the war and all this other stuff going on with the spending, we'll have to see. Right now, I'm like, maybe they're just going to keep them where they're at. That's why I did a video, and I kind of mentioned this before. When you go back and look at those decades, you look at 2000 to 2010, and before that, and leading up to now, you kind of see that rates usually hang around a certain number. Like between 2000 and 2010, it was 6%. 90 to 2000, it was around 7.5%, and so on. So affordability, um, or how much, you can buy, afford, or even qualify for due to rates going up is having a big impact. We saw demand, collapse when rates pretty much more than doubled. This past week or two provides the evidence that I'm talking about. We'll take a look at that in just a second. But Jerome Powell told us they're looking at the labor market. Okay, they're looking at the labor market. They're looking at PCE, yes, but they're looking at that labor market. So, when we see jobless claims rise, and we see especially because the apartment boom's over, rental boom's over. When we see some of those projects come to an end, we're going to see a lot of those people out of work. When that happens, we're going to be we're heading right into recession. That's what always happens with construction jobs. So keep an eye out for that. And then we're going to have, that stagflation that, we always run into. So let me jump in here on some of this. So, just again, as a refresher, inflation measure rose in March more than expected. We saw that spring market was gearing up, looking good, and then of course, we know what happened with rates. Okay, sentiment continues to improve gradually, but the forward-looking sales expectations soften a bit on less than favorable interest rates. Of course, that has to do with the Fed saying, "Yeah, we're probably going to hold off on rates." Wah wah, right? So we'll have to wait and see. Again, a lot of this is just, I had to say, it's just not even necessary. It's just, causing inflation unnecessarily for a lot of the spending that's done unnecessarily. The Fed waiting for this labor crash where I don't agree with it. I think it's crazy, but that's what they're doing. People need to move on with their lives and, have babies and move into houses, right? But that's just not what's happening here as far as the Fed is concerned. They want to see the labor market break. On the one hand, you understand, look, if rates came down right now and went down to like, 5, below 6 for these retail rates, again, we can get you lower rates than what you're seeing. That's not a problem. But because of who we work with and what they do as far as shopping the best rates. But most people they go to their bank, they go to a retail broker that's out there, with all the marketing fancy stuff, and they're paying through the nose, or they just like, wow, I can't afford to buy a house. So, and no matter how you look at it, it's definitely gotten more expensive. So, um, anyway, rates are going to be higher for longer. Excuse me, these allergies are crazy. Continued unemployment claims remain above 1.8 million. Bottom line is initial jobless claims can be volatile from week to week, but their relatively low level suggests that employers are still trying to hold on to their workers, yet continuing claims are still trending higher, near some of the hottest levels we've seen in recent years, as it's become harder for some people to find new employment once they are let go. So that's happening. Again, softening, but hasn't broken yet. We'll see. When that should be this apart, when the apartment or rental boom is over, going to be a lot of unemployment for construction people, unfortunately, and that usually leads us right into, or then we are in that stagflation or recession. We have a recession, rates go down, prices on homes go up. Every recession, I've shown you the charts a million times. Mortgage app volume declines across the board, of course, because rates went back up again overall the past week. Now, we did see that we had a little bit dip in the 10-year treasury, so that's good news. We had all our numbers down. 2-year was down, even with all the nonsense in the news with people saying dumb stuff at the Fed and with the war and all that. Usually that 2-year is really volatile from day to day, week to week, even more than the 10-year. But we're seeing everything down as far as the bond market's concerned. So that's good. That means rates came down a little bit. 30-year fixed, 7 point. Again, these are the average retail rates. You can get lower rates than this, like this here. Look at 6.95%. Okay. Well, maybe they're up a little bit from what I saw about 3 weeks ago with an FHA buyer. I've got 2 or 3 weeks ago, but they were at 5.5 with our mortgage broker. So, guys, that's just not just throwing numbers down. That is like hundreds of dollars per month. Um, and over the life of the loan, it's tens of thousands. Okay. So let's talk. Um, the Fed chairman, Jerome Powell, rates are going to go stay higher for longer. Okay. Yeah. We're probably looking at around, September or later. Hopefully we'll get one or two by the end of the year on the rate cuts. Now those Fed rate cuts are not a direct correlation with mortgage rates, but they affect that bond market. In a 10-year treasury, 2-year, the 2-year, but a 10-year. And that will, be what we're looking for. Also, but the labor data is the key. Watch that. That labor data is the key. When that hits about 323,000, okay, I'm not rooting for this. This is what they're looking for. It's crazy, I know, but they want to stifle the economy so that inflation falls and they feel like it's not, we're not going to go back into an inflationary thing. Well, you know, if you keep doing the same stuff though on the back end, it keeps the inflation going. But that's a whole nother story on the spending and all that and printing money. And the this whole thing was about crashing the inflation, crashing the economy, crashing the labor market, so that they feel like, okay, now inflation is back to 2% increases where we want to see it. Our rate of increases at 2%, and that's their target. Okay, we've been over that target, over the past several months, even though year over year we're quote unquote down. Uh, we were up over 9% when it was at the height of the inflation. But when you track it the old way, how they used to actually, and I think for most people, this makes sense. They used to track it where, if you're making a payment on a house and you're making a payment on a car, for instance, they used to say, okay, we had to take in, your payment with the interest rates on those things and actually look at that's what inflation is. So if we looked at it that way, inflation would be like double what they said it was. Yeah, be like 18, 19%. not nine, not a little over nine. Okay. So yeah, there's that. But anyway, here is an overall picture of our current market here in the Phoenix area. Look at that number right here. So 65 days closed down market. That tells you it's taking, a usual escrow period on the average is going to be right around 30 days. Okay. Typically, it can take longer. It can be shorter, but typically, depending if it's cash, type of loan, all that. But typically, it's going to be about 30 days. So that tells you that it's taking about around on average, maybe a month to get a property under contract, give or take a little bit. 2.98 month supply. That means we're in a, again, pretty much a balanced market. That makes sense in about 3 months. Absorption rates down a little bit. That should definitely be in the 40s, okay, or closer to 40 at least. And then the list price is at 841,000. Okay, that's average list price. The average sales price is now at 620,000 and some change. List to sales price ratio, yeah, 620, guys. That's our average. Okay, prices have gone up. List to sales price ratio. That means it's 98.6. We like to see that just over 98%. That's good. That means sellers are getting pretty close to whatever their list price is if they are getting offers. Active inventory is up a little bit, 18,000. That's definitely better than where we were, in the crazy frenzy market and over the past several months. But, that's still, if we had about another 10, maybe 12, 15,000, that would really be a real normal market, guys. I don't think people understand, how much how long it usually takes for homes to move in a normal market cycle with normal inventory. But anyway, and that's when you really got to know how to sell properties, how to negotiate, how to get out there and hustle, how to be proactive in getting those properties sold, and how to position them properly. Short sales, be careful when you look at percentages. People say short sales are up, 16.7%. Lender owned up 31.6%. Sounds like a lot, right? But when you look at the numbers out of the total pending sales and total closed units, well, it's not really that much. 49 short sales, that's not a lot in an entire MLS, a huge metropolitan area like Phoenix. Lender owned, type of distress or, investor properties, 25. HUD, 3. I mean, it's when you look at the actual numbers and break it down, in other words, it's not a lot. Okay. So be careful when people use percentages. Always want to know, what is the actual number on that? Okay. New listings, down a little bit at 21. Now, this number for new listings coming on the market should be closer to 2,500 every week. Pending sales are up. Okay. Seasonally makes sense. Okay. These numbers should be a little higher, but they are where they are. And the pending sales on the distressed properties, okay. Closed units are down 6.8%. Okay. Again, a lot of that is going to be lagging because usual escrow period is about 30 days, but these higher rates are definitely affecting things. Okay. Now, one thing to take a look at here is these price ranges, okay, and how many units there are, days on market, okay, and the actual percentage of homes that makes up per price bracket, okay. So when you look at the number of homes under that, let's say 600,000, under 600,000, that's going to make up like a little over 60% right there. So when people say, uh, a lot of this is, unaffordable, well, there's still some options out there if you're willing to work with a professional that knows how to help you through that process. Maybe, you just need to be a little bit, more open to area too, and some of the other options. But the main thing is you own a home it's now a whole lifestyle thing. It's now an investment in you and your family. So it's a great way to go. Now, I'm not going to get too far in the weeds here on that, but I am going to tell you that the Cromford Market Index um, is showing us, anything below 90 is a buyer's market, anything above 110 is a seller's market. We are at 111. So for all intents and purposes, guys, we are in a balanced market pretty much across the board. Every neighborhood community around the valley is going to be a little bit different because real estate is local and hyper local, but those are just some things to keep in mind. Let's see. We talked about the average square foot of prices going up. Right now, Chandler, as far as the Crawford Market Index is concerned, Chandler tops the chart as the number one seller's market in the valley at 218. That's up 5% from last month. Gilbert is at 180 for Gilbert, then Glendale at 169, Tempe at 160. Glendale went down 4%, though, even though they're in a seller's market, just FYI. Tempe's up 11% on the chart. Mesa's at 159. But that went down 1% as far as the index is concerned. Avondale's at 156, that's up 5%. Phoenix 155, up 4%. Fountain Hills, that's up let's see, down 9%, but still in the seller's market at 148. Scottsdale's at 131, that's up 6%. Peoria 115. So those are all seller city market advantages, okay? For the most part. Again, slight advantage to the seller, nothing crazy. Although Chandler's, 218, that's pretty good, pretty high on the index. Usually Chandler comes in pretty strong though, pretty much every week. So Peoria at 115. Then we've got Paradise Valley, Surprise. Those two are in balance. Those are in the balance range, 103 and 94.8. Then we've got Cave Creek, Goodyear, Queen Creek, Maricopa City, and Buckeye are right in. Those are in buyers markets. Goodyear, let's see, Cave Creek is down 9% at 89. Goodyear is at 86, up 9% on the index from last month, but it's at 86. So Goodyear is a buyer's market right now. So we'll have to kind of watch that one, see how that goes. That's kind of, going up pretty quickly. The biggest jump this week was Paradise Valley going up to 103, went up 14%. So last month it was 90.8. Wow, that's a big jump. Okay. So guys, that's really all I have for this week. If you guys have any questions at all, would like to know, and these things I was talking about as far as these rates or down payment assistance program, they're also great strategies for sellers, if you're selling a property. So we can talk about that and how we can kind of work those ideas in to bring in more traffic to your property. So if you have any questions at all, feel free to reach out. Love questions. Would love to be able to talk to you more about what it is we can do for you to help you through your home buying or selling journey. And we will talk to you guys next time. Thanks.